Picture this. You wake up tomorrow and your money still works, but it doesn't move like it used to. Your paycheck can be programmed. Your savings can be tokenized. Your assets can trade 24/7. And the wild part? This isn't sci-fi, it's already being built. For centuries, wealth has been stored and transferred through systems we barely question: banks, payment rails, and government-issued fiat currency. But a new architecture is emerging. Cryptocurrencies, stablecoins, central bank digital currencies, DeFi, and tokenized real-world assets, forming what researchers describe as a layered ecosystem where multiple forms of money and value coexist. In this video, I'll break down what's changing, why it matters, and how wealth might work in the next 5, 10, and 20 years, without hype and with real examples. Fiat currency works because we trust institutions, central banks, governments, and the banking system. But the report highlights several structural weaknesses that push people to explore alternatives. Inflation and purchasing power erosion. Even moderate inflation can quietly punish savers over time. Centralized control and trust dependency. Policy errors, instability, or capital controls can trap people inside failing systems. Operational inefficiencies. Cross-border transfers can take days and cost real money. Remittances can eat 5 to 10% in fees. So the question isn't, will fiat disappear tomorrow? The smarter question is, what new layers are forming on top of fiat? And what do they enable that fiat can't? Think of the next era of wealth as 4 toolkits. Bitcoin introduced digital scarcity without a central authority. Value governed by transparent protocol rules. It's often positioned as digital gold, a non-sovereign store of value that can't be printed at will, though volatility remains a major trade-off. Central bank digital currencies are state-issued digital legal tender meant to modernize payments while preserving government control. They promise efficiency, faster fiscal transmission, and broader inclusion, but raise serious debates about privacy and surveillance. Stablecoins aim to combine crypto's speed with fiat's stability by pegging tokens to currencies or reserves. They've become the digital dollars of trading and cross-border movement, but live under growing regulatory scrutiny. This might be the biggest sleeper story: tokenizing real assets, real estate, art, commodities, bonds, so ownership can be fractional, tradable, and programmable. All of this runs on infrastructure. Blockchains, distributed ledgers secured by consensus, cryptography, and often smart contracts. Then comes DeFi, financial services built with smart contracts instead of banks, exchanges, lending, borrowing, and even synthetic assets. And DeFi's superpower is composability, money Legos. One protocol's output becomes another protocol's input, enabling rapid innovation, and also new types of systemic risk if something breaks. Let's make tokenization concrete. Imagine a $5 million property divided into 5,000 tokens. Suddenly, smaller investors can access an asset class historically reserved for institutions, or a bond that pays coupons automatically via smart contracts, or commodities like gold represented digitally while backed by physical reserves. Tokenization promises 3 huge upgrades. 1. Liquidity for assets that used to be slow and expensive to trade. 2. Access through fractional ownership. 3. Automation through programmable rules, distributions, compliance checks, and transfers. In other words, wealth stops being just something you hold and becomes something you can route, combine, collateralize, and move, like software. If this is the future, the risks matter. Because risk is the tax you pay for innovation. The report flags major challenges. Smart contract vulnerabilities. Code bugs can mean irreversible losses. Systemic contagion. Interconnected protocols can cascade when one fails. Regulatory uncertainty. How do securities laws, property rights, and compliance map onto tokens? Privacy versus surveillance, especially with CBDCs. User experience barriers. Self-custody and key management are still too complex for most people. So, the future isn't guaranteed. It's negotiated through technology, law, and public trust. Here's the most realistic endgame. Not one winner, but coexistence. The report argues we're moving toward a layered system where Fiat and CBDCs power everyday payments and government distribution. Crypto serves as censorship-resistant value storage and open settlement. Stablecoins bridge networks. Tokenized assets unlock liquidity in real-world wealth. If you want a simple way to think about it, money becomes programmable, assets become portable, wealth becomes modular. If you found this useful, hit like, subscribe, and comment. Which layer do you think grows fastest? CBDCs, stablecoins, crypto, or tokenized assets?